Oh, hello everyone, it's Susie here from Esoteric Trading Solutions. I hope you're all well, looking after yourself, being kind to yourself, being kind to your family and friends, being kind to your beautiful putty cats, your beautiful animals, your beautiful whatever animal you have, and just being kind to people in the world just to try and make this a better place. Today I'm talking about this article from Alistair McLeod. He's an excellent writer and it's on gold money. And I just really love the way this guy writes. He seriously knows his stuff. There's just no doubt about it. He's just, he's been in the markets for a long time. What he's talking about is the $600 trillion derivatives market. And I had no idea it was that big. I put figures out that it was about 1.2 trillion net, but gross would be about 600 trillion. It's massive, massive market. Excuse me for a minute. I've just had a jam and peanut butter sandwich. It was bloody delicious. So the gross value is over 600 trillion, and I do see this, like Alistair McLeod, as a real problem, simply because there are so many derivatives out there. And don't forget, within terms of derivatives, even for the cryptocurrency market, it's an unlimited market of derivatives. Okay, so in other words, if people sell futures, if they buy futures, or if they buy options or sell options, it's pretty much an unlimited supply of futures, okay, or options, unlike the physical market like Bitcoin, for example, where there's only 21 million Bitcoin. And you can see the problem here, particularly if there's physical supply, there could be a massive problem, because in other words, you have all these derivative contracts out there, and if there's physical supply, you have too many derivative contracts for the physical supply. And that's what you see in other markets as well, and particularly Alistair's talking about it from the gold market specifically, but he also talks about derivatives anyway, and it's a real problem in other markets as well, because even in the fixed interest market, you have heaps of bond futures, bill futures, and obviously with the bill futures, particularly in the Australian market, there is physical delivery, but in bond futures there's a cash delivery in the Australian market. Now I don't know what that's like in other markets in the US, but in other markets sometimes they will have physical delivery, and if that's the case, you've got to deliver the physical bond or the physical bill. And you can see the problem here. If the exchanges can issue as many derivatives they like, then when there's physical delivery, you'll find there won't be enough physical to actually deliver these against these futures or whatever they might be, and that is a real problem. And that's what we're seeing in the gold market at the moment. There's been heaps of swap derivatives in play on the gold market, futures, whatever it might be, and you find the physical delivery of gold is just not there. There's a physical supply of gold. I mean, the gold itself, right? The gold bars, right? And a derivative in itself is a derivation of the underlying physical asset. So it's something that's basically buying or selling a forward price going forward at a standardized price. Say if we're talking about futures, and it's actually issued by the exchange, and you have to put up a deposit, and it's mark to market every second of the day. Okay, now clearly if you've sold a gold future going forward and the price is rising, you're going to lose money. But if you hold it until maturity date and there's physical supply, then you're actually effectively selling your gold at a particular strike price. Okay, and that's the thing, you've got to actually come up with the gold. Now if you don't have the gold, you're going to default basically on that futures contract. So Alistair talks about this article. It's very interesting. I'll put it on YouTube. He talks about what we're seeing in the certainly what we're seeing in the gold market is lethal, because what we're seeing is there's a lot of futures out there where they're actually short, the traders are short, and the fund managers or the hedge managers or whatever, and they have to physically deliver those short positions on maturity, which means they've sold gold futures forward, and when the maturity comes up, if they don't get out of these transactions, they're effectively going to have to come up with gold. Okay, and the thing is, they're all pretty much on the same side, right? And that's why we're seeing such a big disparity between the gold futures price and the physical gold price. Okay, so he actually says that effectively they're dramatically short on COMEX futures. Now if people are dramatically short on the futures market, that pretty much tells you that you know, if the physical gold price starts rising, or even the futures market starts rising, this is going to literally squeeze out all the shorts, and gold could potentially go parabolic, okay? In other words, as the market rises, these guys are still short. They're taking a loss, more and more of a loss, and eventually they're going to have to close out their positions by buying back their shorts, and that will propel the market up even more. So there's going to be a short squeeze, okay? Now, this is also smattering of what we saw in 2008, okay? In 2008, with the Lehman crisis, there was a whole lot of counterparty risk and credit risk and counterparty risk and settlement risk, and there were over-the-counter derivative solutions, and there were CDOs, collateralized debt obligations, and CLOs, which collateralized loan obligations, which had all these over-the-counter complex derivative structures. Now, the problem is, if one counterparty to a derivative structure actually falls over, it creates a domino effect within the market, okay? And this is pretty much what we saw in 2008. If you remember rightly, AIG, which is a non-bank, had to be actually bailed out by the Fed, and because that actually issued or originated all these derivative contracts, right? And basically, if the market moves with massive amounts of volatility, a lot of these derivative contracts blow out to smithereens as well, okay? And it makes it very difficult because what happens is if one counterparty leg also goes broke, it means that you have an open derivative exposure on the other leg. I know it sounds complex, but effectively what it does, if one counterparty falls out of a transaction or a derivatives contract, then you may have hedged that with that counterparty. In other words, hedged your risk, and if the counterparty fails, then you've actually got an open risk, which creates a domino effect for everyone else, okay? So Alistair talks about the Bank for International Settlements last year. According to their figures, global outstanding derivative contracts were around 640 trillion, okay? Now, derivative contracts, if they're not done through the exchange, you can actually have structured derivative products, which are over the counter, and that's what that stands for. So in other words, you can go to banks and they can structure a derivative type contract for you, anything, as long as they can hedge it, they'll do it. And also, even AIG was doing it in 2008, okay? So, it talks about these figures, 640 trillion, which is a massive sum. There's no doubt about it. That is massive. And he also talks about derivative figures being more massive than even the physical balance sheet of the banks or whoever it might be. And he talks about Deutsche Bank. Deutsche Bank's balance sheet, might be, say, in terms of assets, 777 bill, but the derivatives positions are like 35,000 times larger, okay? And that's scary, because what it means is that a derivatives position could cost the bank all its assets if they're wrong, and if there's counterparty that actually falls off against their hedge positions as well, and that's a real extremity, and that will cause a complete domino effect. And that's pretty much what we saw in 2008, and certainly going forward with what's happening in markets at the moment, we could see it again. And I agree with Alistair, absolutely. I know this sounds complex, but it's an added complexity with derivatives, where they keep being issued and issued and issued, which are often larger than the physical market, okay? And if your counterparty to a hedge derivative position goes bust, then you're going to have an open position, and it's going to actually percolate through the market and cause even more risk and more volatility, okay? So, and with these sort of numbers, 640 trillion, it's a scary, scary thing. And I've always thought the derivatives market is one market that is really seriously going to fall over, particularly with counterparty banks that lose their credit rating, like we have seen with Deutsche Bank. Deutsche Bank over the years used to be AAA. Seriously, I used to deal with Deutsche Bank, back in 1994, and they were AAA, and they've been downgraded in terms of credit rating forever and a day, okay? So now a lot of people can't even deal with Deutsche Bank because their AAA credit rating is not AAA anymore. I think they're pretty much around near the lower lows of investment grade, which is not great, because it means their credit quality of the bank has actually deteriorated over time, okay? Very, very bad. So Alistair goes on to say that their trading assets and their trading liabilities on the balance sheet are basically, 80 odd billion and 81 billion, a difference of 1 billion. But the thing is, when you look at their overall over the counter over-the-counter derivatives positions in the notes of the account, it's actually 37 trillion, okay? And that literally, is 35,000%, or 35,000 to 1 leverage, which is massive. So putting it very simply, if these derivatives, if they're not completely hedged and one leg of that derivative position falls over, this bank could expose itself to literally a physical loss of all its balance sheet. And that's the scary thing. And certainly when you see markets like this, and when you see, excuse me, downgrading of corporates and banks, particularly banks, or even people like AIG, who are non-bank originators of many derivative contracts. And some of these derivative contracts are very long-winded. They have a long-term time frame. They could be 20 years or 40 years or 10 years or 5 years. Then, you run the risk that you've got open exposures to financial markets, and which could literally claim your balance sheet, okay, through losses on those derivative positions. And that is very, very scary indeed. And I've always thought, like Alistair, this is absolutely spot on, okay? Absolutely spot on. So not only that, we're seeing in the gold market particularly, and we've seen this in other markets too, there are so many gold derivatives out there, and whether they're being issued from the exchange or whether they're over-the-counter structured gold contracts in terms of derivatives, the fact is most of the market is short. And if the market's short and there's only so much physical supply of gold, you can see what's going to happen here. The gold physical price is going to go through the roof, and the traders are going to get buried, and there's going to be an absolute short squeeze, okay? And that's an absolute fact, okay? Also, it's been exacerbated because of the COVID virus, and also exacerbated by the Fed's quantitative easing story, with literally, rates down to zero, or even in some cases we see different types of rates being negative, because that also plays out in terms of the gold lease rate, which the gold lease rate at the moment is negative. So what happens is, if you have gold and someone wants to cover a position, or someone wants to, they need gold for a certain amount of time, they will borrow gold via you at a lease rate of something, right? Now, me, who holds gold, and I actually own gold, normally I would get a positive return on a lease rate. Normally in the olden days, I'd actually get, maybe 5%, 2% or 3%, for giving you gold for a short period of time. But what's happening now is the gold lease rate is actually negative. And so therefore, if I actually hold gold, why would I want to give you my gold on a lease rate of negative? You know what I'm saying? So the thing is, the gold physical market, there's now a lack of supply, because none of the leases, lessors, I don't want to give you my gold because I don't have any incentive to actually earn negative. Of course I wouldn't, right? So there's actually a lack of supply of physical gold, okay? Not only that, we do see in London, the UK, there's a massive shortage of gold, and and now there's a shortage, in the US as well, because obviously to move gold, physical gold, you have to actually put it on airplanes. It's heavy. You've got to physically put it on an airplane or on a ship, okay? And that's the problem you have, right? Gold can't physically be moved either. So, the London, this is the London, what's it called? The London Exchange, and it's called the CME, which is the US Exchange. The COMEX, which is the US Exchange, has been issuing calming statements, even announced the introduction of a new 400-ounce gold futures contract alleged to ease the shortage of supply. Now, the thing is, in America, they thought they'd try and ease this problem where there's massive gold shortage, gold physical shortage, but also massive gold short futures, okay? So in the UK, for example, their futures are aligned to physical gold of 400 ounces, and in American market, they had gold which was aligned to 100 ounces of the futures market. Physical, you had to come up with physical gold of 100 ounces to 100 futures. Now, COMEX in the American market has issued a 400 ounce gold futures basically to be in line with the UK. thinking that this is going to actually help and ease the supply shortage. But the reality is it's not, because it's still futures and it's not going to ease the physical supply shortage of gold. Okay, so if we look at this, in short, as Alistair says, the gold derivatives establishment is panicking. The swap positions on COMEX show why. So if you look at the swap positions on gold, basically the market, and this is contracts, okay, is about got down to an extreme of about 225,000 short, and it's still around, you know, about 175,000 short. Now this would be literally, you know, 400 ounces of gold multiplied by that, and you know, we're talking a lot of gold here. So the thing is, if these guys that are short or girls that are short, their risk is if the gold price keeps rising, okay, they're going to start losing even more and more money. So what they have to do is basically buy this back to stop themselves from losing more money if the gold price moves up, okay? And this is a very, very large short position. Never been like this before, even back in 2008 or 2006, okay? And it is in a seriously dangerous position here. And as Alistair says, COMEX swaps are badly wrong-footed at the time when the Fed and the other central banks have announced unlimited monetary inflation, signaling a paradigm shift in the relationship between sound and unsound money, okay? Very, very scary, okay? Basically, it goes on to say, an entity that deals primarily in swaps for a commodity and uses the futures market to manage or hedge their risks associated with these swap transactions, okay? The swap dealer counterparties may be pure speculative like hedge funds or traditional commercial clients that are managing risk from their dealings in the physical commodity, right? But the thing is, if you issue too many derivatives in a market where there's only so much for physical, right, and they're all short, you can see the problem, particularly when there is a physical delivery of that market. This tells you that gold, very simply, is going to go parabolic. The physical gold will go parabolic because these guys and girls, as the market moves up, will have to cut these short positions, okay? And it's just going to go whoosh straight away. So very, very interesting scenario, okay? And we do see this in other markets as well. I mean, even in cryptocurrency, you know, don't forget futures, you know, contracts can be issued by the exchanges in unlimited amount of quantities, but the physical market of cryptocurrency only has so many XRP, for example. It only has so many Bitcoin. And this is why I cannot understand why the Security Exchange Commission allowed futures to be issued on a very new and retail and immature market like cryptocurrency, okay, where the professionals are not even in there. So what it means is the professionals keep selling futures on a market that's only about 180 bill, right, or whatever it is at the moment, and there's only so much physical of cryptocurrency. And as the professionals keep selling and keep selling, right, you could find that there will be a short squeeze. Now, it's a question of whether, you know, some of the futures contracts, as I said, have cash delivery or physical delivery. If the futures contracts have physical delivery, you're going to find that if they're all short and they've got to come up with the physical Bitcoin or whatever it might be, there could be a massive short squeeze. In other words, pushing the price up because there's a lack of physical supply. Okay, so that's pretty much the story there, and that's pretty much what we're seeing here. Don't forget also, we've got central banks also buying gold now and hoarding gold, and we're seeing it from the banks in Russia, and obviously the central bank in Russia, and we're seeing it in China, and we're even seeing it in India, okay? So, you know, years ago, the central banks globally, you know, 15 years ago, were selling gold. Now they're actually hoarding gold, right? As a hedge against currency collapse, right? And, you know, it's a real reality. You know, certainly with the US, for example, the amount of, you know, money they're issuing, which is akin to selling the US dollar, the currency could keep going down, 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 and their fundamentals in terms of the balance sheet are getting worse and worse because their debt is rising, right? In terms of currency collapses, the only way you can really hedge that is either through crypto or basically gold. Okay, so in other words, if currency continues to collapse, people start buying Bitcoin or XRP, and certainly XRP in my mind is the better one, and they keep buying gold, okay, to avoid holding your own money or deposits with the bank in the domestic currency, because if you continue to hold it in domestic currency like US dollars, and US dollars keep going down, you're going to actually lose money, okay? And this is pretty much where this is going. Now, I've also said this before, that inflation is in the system, and I do not believe the figures that have come out from any economist, okay? It's all garbology. You know, inflation in the last 20 years has been so high, and I do agree with Alison McLeod. Another article, he was actually saying inflation's around 12%, and I believe that, because I know my purchasing power of the dollar goes nowhere. You know, 20 years ago, a dollar, you know, if I had $100 Aussie, what it would buy me 20 years ago in terms of groceries was amazing, right? I'm even just talking about groceries. Now $100 goes nowhere. You know, what I could get for my utilities 20 years ago, you know, the electricity, whatever. You know, the price of everything is through the roof. Not even, you know, and not even talking about, you know, housing, right, in Australia. You know, 20 years ago, you could buy a 2-bedroom Victorian terrace, you know, where I live in Brunswick, for $125,000. Now they're selling for $1.2 million. This is in Australia, okay? And yet, you know, we're being told that inflation is not here. But the reason why that is because the statisticians change the measure of inflation. In other words, inflation has a lot of components in it, and they basically took out housing prices. You know, let's just take that out. You know, they gave more weighting to something else, like, you know, importing, you know, washing machines from China, which those prices have gone down dramatically. Let's take out certain food prices. So they changed the measure of inflation, and it's just not correct, and that's a fact. So this is a very interesting article, I have to say, and I'd really, really like you guys to read it. It is complicated, I know, if you don't have the background that I've got, but it basically also tells you exactly what's going on in other markets, where there's going to be a physical shortage, and this will happen in the cryptocurrency markets as well, a physical shortage of crypto, because in the futures market there's unlimited supply, okay, unlimited supply of futures, and it should never have happened, okay? So it's an excellent article, this one. It does talk about scams in the gold market, and we've seen them in the fixed interest market and the foreign exchange market. You know, in the fixed interest market, for example, there were scams on LIBOR setting, which also affect the revaluation, the valuation of swaps, interest rate swap curves and everything else. Affected the valuation of bonds, all sorts of things. Now, if you want more information on this, go to my Udemy course. It's called a structured, what's it called again? It's called, you know, structured finance valuation methodology, and I go through all this stuff. I mean, high finance can be quite complicated, okay? But my Udemy course is excellent on describing this, you know. But the thing is, you know, it talks about all the corruption in financial markets, and we've even seen it in foreign exchange markets, you know, the Aussie US price setting rates and levels, you know, because the dealers used to get paid in terms of their trading books and how much, you know, how much they make on their trading books. So the thing is, if they get a bonus, an extra bonus because they're making P&L, then they're going to try and find the lowest or the best prices to revalue their book higher. Okay, so a lot of these dealers were basically, you know, in a lot of trouble, and basically sent to jail for that sort of, you know, that sort of corruption. Okay, so, you know, there is a lot here. Have a look at this. It's a very, very good story. But Alice is basically saying, come June, you're going to see all these contracts expiring, you know, in gold, and there's got to be, you know, they have the option of physical delivery, right? If they hold to the end, to the expiry date, it'll be physical delivery, and they'll have to come up with physical delivery of gold. Okay, now if they close in between time before now and June, they still have to buy back, you know, their current spot short gold position, okay, which means the market will head up anyway. In other words, gold will go up. Okay, so very, very interesting article, and you know, You know, he's talking about the failure of gold derivatives, and again, this brings into play a counterparty risk. Okay, you know, if you have one counterparty, say I'm a corporate and I've hedged my gold position, and all of a sudden, you know, Deutsche Bank's failed and gone broke, then my hedge with Deutsche Bank, it's not there anymore. So now I have an open position, okay, an open position to risk, which is not a great story. Now guys, this is my course on Udemy. It's an excellent course, a structured approach to financial valuation model, and it looks at a lot of different things, all the different asset classes. It looks at interest rate swaps, it looks at derivatives as well. Also has 2 valuation models for XRP, and it's 83 lectures with resources, Excel spreadsheets and everything. Also, you get the other course, cryptocurrency, what's it all about? That's our beginner course, and this is more intermediate to high finance. And if you use a coupon, which I'll put up on the video too, it's €160. Look, this is excellent value. You're not going to get a course like this. Seriously, guys, it's really good, I have to say. Guys, I'll put this up. Have a good read of this, and you know, I'll talk to you very soon. So please do look after yourself. Be kind to yourself. Be kind to your family and friends. Be kind to your beautiful putty cats, your beautiful dogs, and please just make this world a better place. Thank you, and thank you.